Welcome back. In this video, we're going to go through quickly theoretical part of standard depreciation methods. As you have seen in previous video, Depreciation Lab supports many methods, but one of the key methods are standard methods of depreciation, which are SL, DB, and DDB. And these methods are available in free plan, that is free tier plan. You can test the depreciation accuracy for these three methods under the free plan. Let's start with straight line method. So it is an equal depreciation every year for straight line method. It is predictable, audit ready, and it is US GAAP and IFRS preferred method. The formula for straight line method is simple. It is cost of your fixed asset, which is the landed cost of your asset. Then you have to predict a salvage value. That would be the residual value of your asset at the end of its useful life. Then you need estimate of useful life that you have to divide, and you'll get an annual depreciation. So it's simple: cost minus salvage value divided by useful life of the asset, and you get the annual depreciation. So here in example below, we have a delivery van, which is a fixed asset vehicle. So it has a $40,000 cost. You deduct salvage value, 5,000, and you'll get 35,000. You divide that by 5 and you get annual depreciation of $7,000. So if you buy mid-year, the Depreciation Lab calculates exact days and adjusts the depreciation automatically. No manual fraction needed. And also it handles the salvage value very smoothly. It subtracts from the cost before dividing. So no residual value, enters 0, and the engine handles it correctly. Now, declining balance method, or I should say diminishing balance method, is an accelerated depreciation method. Fixed rate applied to the declining book value each year. So the formula is simple. It is the book value, that is written down value as of date or beginning of the year, into depreciation rate is equal to annual depreciation. The formula is a geometric formula, that is, you need to derive the rate first. So to do that, you will need to apply this formula, that is 1 minus salvage value divided by cost. You need to raise the power, that is 1 divided by useful life. And I know this is a complex formula and you might get scared if you see it for the first time, if you never come across, and it can get complicated. You're going to use even in Excel, but our app handles it perfectly. You don't have to calculate this. You just enter the cost, salvage value, and life in the designated fields inside the Depreciation Lab, and the engine derives it automatically at the back end and calculates it perfectly. There are some caveats, so you need to be careful. So it needs minimum $1 of salvage value. So DB is geometrically derived from the cost and salvage value. Setting salvage value to 0 breaks the math. As usual, the engine forces minimum $1 automatically when DB is selected. The DB method is selected. Finally, a salvage plug. In the last period, DB applies a small plug adjustment, so closing book value lands exactly on salvage value, not above and not below. This method is best for assets with rapidly early obsolescence, vehicle electronics, heavy machinery. Accurate models the real problem pattern where value loss is front-loaded. So that's when you use diminishing balance method or declining balance method, whatever you want to say, in those scenarios. Now, the third standard method supported by Depreciation Lab is double declining method or DDB method. It's the most aggressive front-loading configured factor with automatic SL crossover switchover. The formula of DDB method is rate is equal to factor divided by useful life. So default factor is always 2, that is 200 of DB. So you can configure the factor in the app. So 100% DB is equal to straight line, 1.5x, that is 150% of DB method, and the default is 2x or 200% DB, that is standard DDB. It is set by default in the app. So for example, if 5-year asset at 2x, the DDB rate would be 40 of SL rate, that is 20%. The 1-year DDB deduction is equal to 2x of straight line equivalent amount. So the app has some auto switchover which is compliant with IFRS and US GAAP. So auto SL switchover. So when remaining book value divided by remaining years exceed the DDB deduction, the engine auto switches to SL, maximizing the total deduction. So it has a validation rule as well. So minimum useful life is equal to 2 years. So depreciation factor cannot exceed useful life. Both enforced automatically on this input. This method is best for technology, R&D equipment, and any strategy focused on maximizing front-loaded tax deductions. Now you can see the method comparison and when to use each of this method depending upon your business and especially the fixed asset you are dealing with. So 3 methods handle partial years in the app, in the Depreciation Lab app: improvements, impairment, disposable, of course. So all these 3 methods handle partial years, improvement, impairment, disposals in the Depreciation Lab. So you can see the grand summary of the 3 methods. So straight line method is the simplest method, equal depreciation each year, best for building furniture, long lived assets. Financial reporting, US GAAP and IFRS preferred. So if there is a non-salvage value, the asset's useful life will depreciate it to zero. The asset's full value will be depreciated to zero. The declining balance method is a diminishing balance method, as I mentioned before. It's book value into rate. That's the formula. It's high early depreciation, declines over a time. So the depreciation will decline over a later part of the life of the assets. It is best for vehicle, electronics, machinery assets losing value rapidly in early years. So the key constraint is minimum salvage value of $1 is auto-enforced in the Depreciation Lab calculation engine. The double declining balance method is a factor divided by life into book value. It is mostly front-loaded and auto-switch to SL. It is best for technology, R&D equipment, max front-loaded depreciation deduction strategy. That is for tax purpose. And the constraint is minimum useful life of 2 years is required. If your useful life is less than 2 years, the method will not work. The calculation will not work. So we will move to the next part of the video where I'll explain more about these methods. Now I will take you through the standard methods which are available in the app. So as you can see on the left side of your screen, after you sign up, even with a free account, you can see the standard methods here. So under standard methods, you will have an option to choose which method you want to apply depreciation. So if a particular asset has a depreciation, if you want to apply depreciation for straight line method, it is here. You can apply declining balance method, that is diminishing balance method, or double declining method. So if you choose double declining, you see there would be a factor here, as I explained earlier. So in the app, the standard method contains the option and drop down to select either 3 of the methods according to your asset type. Also on the demo page, if you go back and see on the demo page, and if you go to standard methods, you will see you have option to choose these methods. So even before sign up or even before you decide to sign up or subscribe to any plan, you can always test each method with a single asset and see the outcome. So this was my video on standard methods. If you have any doubt or question about standard methods, I'll be happy to help you and explain to you any technicalities of this method. And I'll catch you up in the next video. Thank you so much for watching.